Welcome to your channel, Dr. Gazavi. Economics and financial issues are very important. Let's go.
The aim of the paper is twofold. First, to examine the hedging effectiveness of cryptocurrencies and cryptocurrency portfolios for European equities in bearish and bullish market conditions, and second, to contrast cryptocurrencies with gold as a safe haven asset. To this end, daily data from 2018 to 2022 were employed in a linear and nonlinear autoregressive distributed lag (ARDL) framework. The findings have significant implications for investors, financial intermediaries and regulators. Cryptocurrencies have become increasingly popular among investors, and for a certain period were hailed by a number of authors as the biggest financial innovation of the century. They have attracted increasing scrutiny on the part of investors, financial institutions, policymakers, regulators, and the media. Fintech and blockchain are key instruments among technology leaders in finance today. The growing interest in cryptocurrencies is testified by the possibility of using them as a mode of payment in an increasing number of countries and the support received from corporations like Tesla, Meta, Microsoft, Starbucks, Dell, Visa, and Quinn Emanuel in the U.S., for an in-depth analysis of the spread of cryptocurrency across countries (CEG). Since the outbreak of the COVID-19 pandemic, the spread of cryptocurrencies, utility tokens, and security tokens has undergone a further acceleration, reaching a peak in total market value of nearly $3,000 billion in November 2021. Despite the crisis of many players in the crypto market in the past year and the sharp contraction in terms of total market value, crypto continues to grow with more than 22,000 cryptocurrencies traded on about 530 exchanges in December 2022. Although cryptocurrencies were not created for investment purposes, they have attracted more and more savers. Especially young retail investors point to the increasing spread of cryptocurrencies in investor and company portfolios raises issues relating to their effectiveness in terms of portfolio diversification and hedging. Conclusions. This paper has investigated hedging effectiveness and asymmetric correlations of two cryptocurrencies, Bitcoin, Ethereum, a stablecoin, Tether, cryptocurrency portfolios, and gold for the European stock market. From the investor's point of view, it is essential to assess whether these innovative investment opportunities can provide benefits in the mitigation of portfolio risks. Changes and increasing market correlations over time, (e.g., Fraines et al., 2017), have posed crucial challenges for investors, who seek to identify financial assets that can retain or even gain value during periods of market turbulence. In this context, this study has examined safe haven properties of two cryptocurrencies, Bitcoin and Ethereum, a stablecoin, Tether, and cryptocurrency portfolios and contrasted them with gold as a benchmark. As a reference for European stocks, the Euro Stoxx 50 index was used, covering 50 of the largest and most liquid stocks, blue chip, in 8 Eurozone countries. Following Campagne et al. 2020, the study applies to the dataset both linear and nonlinear ARDL models for investigating the relationships between stocks and innovative assets in bearish and bullish markets. Using a nonlinear ARDL model allows us to assess whether positive and negative returns of cryptocurrencies may affect the stock market differently. The following findings have been obtained. First, among the crypto assets under investigation, Bitcoin, Ethereum, Tether and the 6 cryptocurrency portfolios, only Tether proved to be an overall safe haven for the Euro Stoxx 50 during the period 2018 to 2022. In particular, Tether positive returns are found to be negatively related to stocks in 2 out of the 3 bearish market phases, 2020 and 2022, considered in our sample, indicating that European investors can benefit from stablecoins in order to hedge or diversify their portfolios. On the other hand, Bitcoin and Ethereum are found to be the most closely correlated to the stock market, showing a significant relationship in 4 out of 5 market phases. Second, the NARDL model used to disentangle positive and negative returns casts light on the existence of an asymmetric relationship between cryptocurrencies and stock market returns during bearish market phases. More specifically, a strong positive short-term association has been detected between negative BTC/ETH returns on the one hand and stock market returns on the other, indicating the possibility of large joint losses in the event of market turbulence. Therefore, in line with Gesmi et al. 2019, a short position on Bitcoin or Ethereum can be exploited as a hedge for European stocks during bearish periods. Third, unlike Bitcoin and Ethereum, cryptocurrency portfolios are unrelated or only marginally related to market returns in most cases, suggesting that the cryptocurrency portfolios may be more suitable than Bitcoin and Ethereum for diversification purposes. The lower association of a cryptocurrency portfolio with market returns could be related to different investor perceptions of the cryptocurrencies that compose it. Suppose one or more cryptocurrencies feature positive news about their fundamentals or the underlying technologies. In that case, it can attract more investor support and gain momentum even in a turbulent market period and consequently improve the overall portfolio performance. Fourth, as regards the composition of the cryptocurrency portfolios, a basket made of the top 10 cryptocurrencies achieves the highest diversification benefit among cryptocurrency portfolios, showing a better risk-return profile compared to portfolios made up of a large number of minor cryptocurrencies. Fifth, the results reveal that gold acted as a safe haven during the bear markets in 2018 and 2022 but not during the COVID-19 related downturn in 2020, raising the need for alternative safe haven investments. Finally, the results obtained for the Euro Stoxx 50 index remain valid when investigating 5 major markets of the euro area such as Germany, France, the Netherlands, Spain, and Italy. Minor differences have been found for Spain and Italy since these markets are less closely correlated to cryptocurrencies, suggesting higher diversification opportunities. We believe that the results of the paper will be of interest to investors, financial intermediaries, and regulators. Investors could exploit the results for asset allocation purposes or to improve forecasting models. The findings indicate that adding a single cryptocurrency to a stock portfolio does not provide effective hedging during market downturns and can increase the risk of short-term joint losses. However, adding a mix of cryptocurrencies to a stock portfolio might lead to some diversification benefits. In particular, given the speculative characteristics of cryptocurrencies and their enormous volatility, any investor exposure to these assets should be viewed more as an opportunity to increase portfolio return than insurance against downside risks. As suggested by Petuhina et al. 2021, cryptocurrencies can improve the risk-return profile of portfolios, but their investment benefit depends on investor objectives and characteristics. On the other hand, including a stable coin in a portfolio made up of European stocks may provide a hedge or diversification during bearish market phases. The emergence of a positive effect from cryptocurrencies in terms of diversification benefits can be favored not only by specific market conditions but also by developing adequate innovation in the underlying technologies and projects. Investment product managers could rely on these results to develop tradable assets that replicate an investment in multiple cryptocurrencies to provide investors with an additional tool to diversify their holdings. Regarding optimal portfolio allocation between the different asset classes, the solution needs to be established by investors and fund managers and must reflect the individual investor's risk profile, taking into account that cryptocurrencies are extremely volatile. In light of the results of the present study, cryptocurrencies can be viewed as alternative investment solutions in periods characterized by bullish market conditions and low volatility. On the other hand, given their tremendous volatility, the high exposure to tail risk, and the increasing short-term correlation with traditional assets, cryptocurrencies can carry high risks, especially for small investors with insufficient financial knowledge. In fact, from the investor's point of view, it can be difficult to operate in the jungle of new crypto projects. Currently more than 20,000 cryptocurrencies are traded, often characterized by high levels of complexity and highly innovative and technological content. The increasing market complexity is related to the fact that different cryptocurrencies rely on different technologies and characteristics to achieve specific possibilities for potential users. Antonikakis et al., 2019. Along with the high degree of uncertainty about their intrinsic value, Borgards and Zudai, 2020, makes it a challenging task for an investor to assess the value of a cryptocurrency. Therefore, the crypto market characteristics can stimulate the entry of specialized companies that can select projects and create portfolios to be subsequently traded in traditional markets or exploit traditional channels, e.g., exchange-traded funds. The focus of regulators and policymakers should now be devoted to the research of appropriate solutions to protect investors intending to enter these markets, even with the support of traditional intermediaries and commonly used investment channels, e.g., ETF. First, a greater awareness of risks is essential for investors approaching the cryptocurrency market. At the same time, regulators and policymakers should move towards tighter regulation for companies that offer cryptocurrency investment services to the retail public, including increasing transparency requirements and assessing cybersecurity systems before issuing a permit or license to cryptocurrency exchanges. 16. A better assessment of these risks can help prevent the recurrence of situations such as high-risk business deals, potentially fraudulent activities, and in the worst case the failure of major exchanges and institutions. In particular, in a market characterized by the lack of a central regulatory institution with the function of lender of last resort, intermediaries are exposed to sudden and extreme financial phenomena such as bank runs and credit crunches, and the collapse of an institution can have cascading effects on the cryptocurrency and traditional markets. Future research should constantly monitor the evolution of the interrelation between cryptocurrencies and traditional asset classes over time. For instance, researchers could examine whether the recent introduction of cryptocurrency-based derivative contracts in traditional financial markets could mitigate the volatility of these assets. In addition, as suggested by Wang et al., 2022, the increasing number of investors adding cryptocurrencies to their investment portfolios could result in a stronger connection between cryptocurrencies and traditional markets.
Thank you for watching, and please subscribe to our channel. Economic and financial issues are very important. See you in the next video.